In this video, I'll be revealing the 401k strategy that it's missing from Fidelity's guidance based on one of their articles. Through analyzing Fidelity's official retirement guidance versus the strategies that actually enable early retirement, I've discovered that their save more, work longer approach neglects a few key principles that could transform your retirement. And that's exactly why I'm making this video today, to go over what this 2023 Fidelity article doesn't cover and show you the advanced 401k strategies that can unlock retirement in your 50s instead of your 60s. So let's get right into it. In that Fidelity article, they actually start off with some ideas that sound perfectly reasonable. Things like making sure you contribute enough to get your full employer match, or even using an HSA to save more efficiently for healthcare in retirement. Those are great ideas. And those points, they're harmless and, probably even helpful, but then the advice becomes questionable. So Fidelity suggests that you should go further by putting after-tax money into your 401k plan. And this means that you're mixing your pre-tax with your post-tax dollars in the same account. And that's where the strategy becomes a trap, because what looks like you're saving more on paper actually locks your money away and creates complications that can hurt your flexibility later on. Here's the problem. Fidelity promotes this idea of stuffing after-tax dollars into your 401k, sometimes up to that $70,000 or $76,000 combined limit if you're over 50. But once that money goes in, you lose control. It gets locked inside your employer's plan, tied to a small menu of investment options, and you can't freely touch it until you either leave the company or you reach your retirement age. And that means that no matter how much you contribute, that money isn't truly optimized for you. It's sitting in a cage where the institution earns ongoing management fees while you lose the flexibility that you need in order to really have your goals met if you're trying to retire early. And add to that even a little bit more complication, that there's the danger of paying taxes on the same money twice. Record keeping gets messy between the institution tracking it and your tax preparer interpreting it, and you're trying to keep records straight for decades. It's easy to lose track of what's already been taxed and what hasn't. So if you compare that with a regular taxable brokerage account, the difference is night and day. With a taxable account, you've got immediate access to both your principal and your gains, and there's no waiting on employer rules or retirement age. You also get unlimited investment choices instead of being boxed into a handful of funds that your 401k plan offers. And when it comes to taxes, taxable accounts actually give you more flexibility. You can use strategies like tax loss harvesting, capital gains harvesting, and even timing your withdrawals in a way to minimize your tax bill. And that combination of control and efficiency is what makes taxable accounts so much more powerful for anyone who wants the option to retire in their 50s. This is something that Fidelity's locked up 401k suggestion makes very difficult to do. So while after-tax 401k contributions create all kinds of restrictions and headaches, there's an even bigger issue that most people overlook, and that's what happens with your pre-tax contributions. Now, when I say pre-tax, I'm talking about the part of your income that you're deferring into your 401k without yet paying taxes on those dollars. Now, many people, they talk about this future tax liability as a ticking time bomb inside of retirement accounts, and I tend to agree with that, because what you're really doing is you're building a future tax bill that grows right alongside your investments. So as your balance compounds over decades, so does the government's share of it. And once you retire, well, those big balances, they trigger required minimum distributions, forced withdrawals that can really shove you above the tax brackets that maybe you don't want to be in, whether you need that money or not. And to make it worse, every dollar coming out is taxed at ordinary income rates, not the lower capital gains rates that you'd get in a taxable account. So in other words, when you load up your pre-tax 401k with pre-tax dollars, you're essentially entering into a long-term partnership with the IRS. And The more successful that you are, well, the bigger their cut becomes. And here's why this tax bomb is even more dangerous than maybe even a market drawdown. So with the markets, risk is something that you can manage. You can diversify, you can adjust your allocation, or you can even hopefully ride out a downturn. But with pre-tax money, you're exposed to risks that you can't really control. Those tax rates, they're not fixed forever, right? Congress can change them anytime. And if rates go up, then your future withdrawals become instantly more expensive. On top of that, required minimum distributions, they force you to pull that money out whether the market is up or down, which can wreck your flexibility and your tax bracket in the same year. And get this, the better your investments perform, now the bigger your tax problems are. So many retirees, they spend years stressing about market ups and downs, but the truth is it's the tax bomb inside of their 401k that ends up costing them the most. And the crazy part is that this entire mess it's preventable with the right strategy. So if pre-tax contributions are setting you up for a massive tax bomb, well then what's the smarter alternative? And that's where most people overlook one of the most powerful tools in early retirement, and that's just the plain old taxable brokerage account. A taxable account is an account where you place your after-tax savings, and it's not tax-deferred like an IRA. So let's talk about how these can be helpful, because while Fidelity's guidance pushes you deeper into pre-tax and after-tax 401k traps, the real advantage comes from flexibility and tax efficiency of the money that you can access on your own terms. Taxable accounts can be powerful, especially if early retirement is your goal. First, you have complete access to your money, no penalties, no waiting until you leave a job, no hoops to jump through. And then second, the tax treatment is far more favorable. So withdrawals from a 401k, they get hit with that ordinary income tax rate, but gains in a taxable account, they're taxed at long-term capital gains rates, which are usually much lower. On top of that, taxable accounts give you tools like tax loss harvesting, using losses to offset gains year after year, something that a 401k can never do. And when it comes to passing wealth to your family, taxable accounts often receive a step up in basis, wiping out capital gains entirely, while 401k balances, they stay fully taxable to your heirs. So for example, if you've purchased something for $100,000 and it grew to $500,000, well, at death, that taxable basis is $500,000, not $100,000. So they don't get taxed on your growth, only the growth that they receive if they continue to own that and it grows after they've owned it. A simple taxable brokerage account can actually be a much better wealth building tool than those after-tax 401k contributions. So with a taxable account, you've got unlimited investment choices. So you're not stuck with a narrow window of funds for that your employer picks out that you get to choose from. So that means better diversification and potentially stronger returns over time. And on top of that, you control when you take the gains and the losses, which lets you manage your taxes strategically instead of being forced into complex distribution rules. So again, I like that you have immediate access to your money, no penalties, no waiting for you to leave your job, just flexibility. And I like that there's that lower long-term capital gains tax rate usually, and the ability to access the funds anytime you want. Taxable accounts, they often give you more freedom and control when you're on the path for early retirement. So now that you see what Fidelity leaves out when it comes to after-tax contributions versus the taxable accounts, the big question becomes, how do you actually design your dream retirement? So if you're wondering which steps to take, I want to encourage you to click the link below to watch a free training that myself and my team put together. And in it, we'll walk you through exactly how to map out your retirement strategy so that you can create the retirement reality that you've always wanted. So be sure to check that out. Another complication with the advice of saving after-tax money in a 401k is how it makes Roth conversions within a 401k far more complicated, which is another reason that I don't like it. So to move that money into a Roth, you usually need an in-service withdrawal, or you need to even change your job just to be able to do it efficiently. And on top of that, The pro rata rules inside many 401k plans can create unexpected tax headaches because your after-tax money often gets mixed with pre-tax dollars. And if your employer's plan doesn't allow for immediate conversions, well, then you're stuck watching that after-tax money grow in a taxable way, which is exactly the opposite of what you wanted by putting it in there. And all of these layers of complexity, they increase the chance of mistakes that can lead to surprise tax bills. So if you compare that to just contributing directly to a Roth IRA, it's simple, it's clean, and it avoids all of the employer plan restrictions. So your contributions, they're accessible anytime without penalty. You've got unlimited investment options inside of a Roth IRA, and you're not tied to the complicated conversion rules. And if you want to save more than the lower amount that IRAs allow, you could just save directly to your Roth 401k plan instead. Now, in short, Roth IRAs are better in that they have more options to invest in and less employer restrictions. But Roth 401ks can allow you to save more than you can in a Roth IRA. So they both have their place. The key lesson here is that in all of these approaches, taxable accounts, direct Roth contributions, and simple strategies, they're better than putting after-tax money into your 401k. So why is it that after-tax 401k money is still promoted? Well, one reason may be fees. Assets inside of a 401k often generate ongoing management revenue, and locked funds means predictable streams of income for the provider. With taxable accounts, you have more flexibility to move money around, and that flexibility doesn't always work in their favor. The complexity of after-tax contributions and then the conversions, that might also play a role because the more complicated the rules, the more likely that investors are going to feel the need for professional help, which naturally supports advisory services. And here's where it gets tricky. Early retirement often shortens the number of years that people stay under management of those big institutions because people, they tend to either learn to do it themselves or they work with a more dedicated team in retirement because the stakes are higher when you're closer to that point of your life. And that doesn't make their advice bad, but it does mean that we should be thoughtful about whose interests are being served when we're told to maximize our contributions. So now that you see the limitations of this advice around 401k contributions, let's take a look at a more complete retirement strategy, one that's designed to keep things simple and flexible. So how should you be saving up for an early retirement? Well, it follows a clear sequence. So step one is simple. Always take full advantage of your employer 401k match because that's free money. It should never be left on the table. Now, beyond that, you can keep adding to your 401k, but here's the key. You want to find the balance between reducing your taxable income today and managing what your future tax bill will look like. Every tax dollar lowers your taxes now, but those same dollars become fully taxable when you withdraw them later. So you want to strike the right balance between your current bracket and the future bracket that you're aiming for. And once you've addressed that, the next layer is the Roth IRA contributions. Or if you earn too much to qualify to put it into a Roth directly, you can do Roth 401k contributions through your employer. But either way, the goal is to create tax-free growth and penalty-free access to your contributions, which adds flexibility to your plan. And after that, additional savings belong in taxable accounts. And this is where you gain the most freedom. You have unlimited investment choices, you have immediate access to funds, and you've got the ability to manage taxes strategically through timing your gains or using tax loss harvesting. So that flexibility is what makes retiring in your 50s possible instead of waiting much longer. So the principle behind this strategy, it's really simple. You want to keep it flexible. Use your pre-tax dollars wisely. Layer in Roth contributions for that long-term tax freedom. And then you want to lean on taxable accounts for independence. So what you're doing here is you're focusing on that full tax picture, both now and later, so you can avoid getting boxed into complicated employer plan rules. And if you do look for professional help, make sure it's from someone who understands early retirement, not just someone repeating the maximized contributions playbook. Now that you understand some of the advanced 401k strategies that often get left out of the standard playbook, you already are one step closer to taking control of your financial independence timeline. So if you'd like some guidance on putting these strategies into action and building your own path to an early retirement, I want you to click the link below to watch a free comprehensive training that my team and I put together. And in it, we're going to walk you through exactly how to create a retirement plan designed around your goals and your timeline. Thanks for watching. I'll see you in the next video.